Three small business credits show up a lot on the EA exam: the Disabled Access Credit, the FICA Tip Credit, and the Small Employer Health Insurance Premiums Credit. Your job is to spot eligibility fast, pick the right form, and remember the gotcha interaction. When you take certain credits, you often must reduce the related deduction by the credit amount. Start with the Disabled Access Credit. It's non-refundable and aimed at truly small businesses. Eligibility is an either-or test based on the prior year: gross receipts of $1 million or less, or no more than 30 full-time employees. The credit is 50% of eligible access costs, but only the amount over $250 counts, and only up to $10,250 of spending. Mechanics are where they try to trick you. The maximum credit is $5,000 per year. Think of it as: take qualified expenses, subtract $250, then multiply by 50%, but cap the expenses at $10,250. If the business spends more than that, you still top out at a $5,000 credit. And don't forget, the deduction for those access expenditures is reduced by the credit amount. Next, the FICA Tip Credit. This is huge for restaurants and bars, and the exam loves the limitation. The credit is the employer's share of Social Security and Medicare taxes on employee tips, but only on tips above the amount needed to bring wages up to an applicable minimum wage of $5.15 per hour. And it's only for food or beverage establishments where tipping is customary. Form matters here. The FICA Tip Credit is computed on Form 8846. A quick way to think about the $5.15 rule is this: if the employee's cash wage is below $5.15, part of the tips are treated as used to meet minimum wage and don't generate the credit. On the EA exam, they'll often give you hours worked, cash wages, and tips, and ask what portion of tips qualifies. Finally, the Small Employer Health Insurance Premiums Credit, also called the Small Business Healthcare Tax Credit. This one is refundable, which is unusual for business credits. To qualify, the employer generally must have fewer than 25 full-time equivalent employees, pay at least 50% of employee premiums, and offer coverage through the SHOP marketplace. The maximum credit is up to 50% of the employer premium contribution, and it phases out as the business gets larger and wages rise. 2 exam reminders to wrap the rules together. 1. Refundable versus non-refundable. Disabled Access and the FICA Tip Credit are generally non-refundable business credits, limited by tax liability. The Small Employer Health Credit is refundable. 2. Deduction reduction. For Disabled Access and the Health Insurance Credit, you reduce the related expense deduction by the credit amount. That prevents a double tax benefit. Marcus owns a popular barbershop with 10 employees. In 2023, his gross revenues are $900,000. He makes $24,000 of modifications to provide restroom access to customers with disabilities. What is the amount of Marcus's Disabled Access Credit? The choices include 0, $5,000, $24,000, or $12,000. Think about it. The answer is $5,000. He meets the small business test because gross receipts are under $1 million. Then the credit is 50% of eligible expenses over $250, capped at $10,250 of spending. Since he spent $24,000, he hits the maximum credit of $5,000. The tempting wrong answer is $12,000, which is 50% of $24,000, but the cap blocks that. Ethan is a professional securities broker-dealer. His business is an S corporation, and he's the sole shareholder. He's single. In 2023, his taxable income before any QBI deduction is $268,000. Is he eligible for the $199, a 20% QBI deduction? The options range from not enough information, to no, to partial, to yes. Think about it. The answer is no. He is not eligible. Brokerage services are a specified service trade or business, an SSTB. For SSTBs, once taxable income is above the top of the phase-out range, the QBI deduction is fully disallowed. At $268,000 for a single filer in 2023, he's above the full phase-out threshold, so the deduction goes to zero. A tempting choice is partial, but that only applies inside the phase-out range.